Welcome to the Riskwiser Zone. I'm your host, Lewis, and we're excited to dive into the latest developments in the world of finance. Today, we're shining the spotlight on Clip Money Inc., a company that's making waves in the cash management space with its innovative digital transformation solutions. According to their recent press release, Clip Money has seen significant growth in 2025, with total revenue reaching $5.74 million, more than double the $2.36 million reported in 2024. The company's CEO and co-founder, Joe Arridge, attributes this success to the market's readiness for a digital overhaul in cash management. By expanding its user base and scaling to over 8,000 retail deposit locations, Clip Money has achieved the necessary distribution to conveniently service businesses across the U.S. This growth is not just about numbers, it's about creating an essential financial utility that supports commercial businesses of all sizes. Clip Money's audited consolidated financial statements reveal a net loss of $9.07 million in 2025, slightly improved from the $9.34 million net loss reported in 2024. The company's total assets stand at $9.81 million, while total liabilities have increased to $25.84 million. Despite these figures, Clip Money remains optimistic about its future prospects, with a record-breaking Q4 and the largest opportunity pipeline in its history. As we analyze Clip Money's performance, it's essential to consider the broader context of the cash management industry. The company's focus on customer value and support has led to a loyal customer base, with a retention rate of 99% in 2025. However, the industry is not without its challenges, and Clip Money will need to navigate these complexities to maintain its momentum. We'll be keeping a close eye on Clip Money's progress and exploring more stories from the world of finance. For now, it's clear that the company is making significant strides in the cash management space, and its commitment to innovation and customer satisfaction is worth noting. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're discussing some of the most pressing investment topics of the day. Our previous segment highlighted the importance of diversifying your portfolio in today's fast-paced market. Now, let's dive into a story that caught our attention, focusing on why Microsoft might be considered one of the best artificial intelligence stocks for retirees. According to a recent article, Microsoft's well-rounded business provides long-term stability, which is a crucial factor for retirees looking to invest in AI without taking on too much risk. The company's diversification across gaming, cloud computing, office software, devices, and other segments offers multiple avenues to leverage AI and add value for its customers. The article also points out that Microsoft's financials are incredibly strong, with over $119 billion in profit generated over the trailing 12 months. This, combined with a modest price-to-earnings multiple of 22, which is in line with the S&P 500 average, makes the stock an attractive option for those seeking exposure to AI with relatively lower risk. Moreover, Microsoft pays a modest dividend of about 1%, providing retirees with a regular income stream. While there are always risks associated with investing in the stock market, Microsoft's stability and diverse revenue streams make it an interesting choice for those looking to balance risk and potential return. It's also worth considering that while Microsoft has been identified as a strong contender in the AI space, other analysts may have different opinions on the best stocks to invest in. Ultimately, it's essential for investors to conduct their own research and consider their individual financial goals and risk tolerance before making any investment decisions. Welcome back to the Riskwiser Zone. As we wrap up today's show, let's take a look at some of the latest developments in the global markets. We've got a fascinating story for you, with news that could potentially impact your investment portfolio. It appears that the ongoing conflict has led to a significant shift in public opinion, with a recent survey indicating that a majority of Americans are in favor of a peaceful resolution. This change in sentiment has been reflected in the financial markets, where stocks have experienced a surge in response to hopes of a potential ceasefire. The Australian market, in particular, has seen a boost, with mining stocks such as BHP and Rio Tinto experiencing significant gains. The price of gold has also strengthened, leading to a rise in gold stocks like Northern Star and Evolution Mining. Meanwhile, energy stocks have taken a hit, with companies like Woodside Energy and Santos experiencing losses. The potential end to the conflict has also had a positive impact on the aviation industry, with airlines such as Qantas and Virgin Australia seeing an uptick in their stock prices. And in the tech sector, companies like WiseTech and Zero have experienced gains, tracking the performance of their peers on Wall Street. Now, it's essential to remember that the situation is still fluid, and investors should exercise caution when making decisions. The conflict has already had a significant impact on global trade and economies, and it's crucial to consider the potential risks and uncertainties associated with any investment. As we close out today's show, it's clear that the path forward will be shaped by a complex array of factors, including geopolitical developments, economic indicators, and market trends. As always, it's vital to stay informed, diversify your portfolio, and consult with financial experts before making any investment decisions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.